Good evening. This is David Priest with Paratus Commercial Group. I'm here with Dustin Miles and Hayden Harrington of Momentum Multifamily. We're here to talk about the last tranche of their Fund II. We've got three properties that are in this fund that we're working on, and this is going to be the last opportunity to participate in this. So I'm going to get right into it. We're going to go right into this and explain. This is a very exciting preferred equity opportunity. And there's also upside on the back end, and it's backed by properties that are already performing very, very well. So I think this is going to be a great investment opportunity. Just to be transparent, me and my wife have already put $100,000 into this investment. So we always place our money first. I don't ask people to invest in deals that I'm not invested in myself. Give me just a moment. I'm going to share my screen and we'll get right into it. And then I'll have Dustin and Hayden here for Q&A at the end. So we'll do unlimited questions for anybody that has any questions. All right, everyone should be able to see everything on the screen. This is for the Momentum Multifamily Income Fund II. This is an A- property, 360 units built in 2007. It's the Henry at Deerbrook. This is a current property they own. It's a stabilized property. A little bit of housekeeping before we get started. Just a general disclaimer. The business plan we're going to present has privileged and confidential information. It's not to be shared without permission. The SEC has not reviewed this or passed upon the merits or given approvals to the securities we're going to offer. We're not offering securities tonight through this presentation. This is for educational purposes only. Those will be offered through a private placement memorandum that you'll need to review and sign to participate in the investment. We're looking at and have forward-looking statements and predictions based on current information, assumptions, expectations, and the knowledge and experience of our team. We're also going to have future financial projections and forecasts. These are not guarantees of investment results. And most importantly, if you need help as far as financial planning, or if you need legal help or accounting help, please get those professionals. Nobody on this call is a licensed professional, and we're not offering any type of advice on those items. So let's get right into it. There's a really beautiful picture of the property. And this is a gorgeous property in the northeast part of Houston. Very familiar with it. So first of all, let's talk about our partners on the team. Dustin Miles. Dustin, why don't you introduce yourself and tell us a little bit about yourself?
Yeah, sure thing. Yeah, my background's in engineering. Live in Fort Worth, and yeah, I've gotten into multifamily 2012. Syndicated my first deal 2014, and done a total of 18 deals. And gone full cycle on 9. Might be a 10th one here pretty soon, and yeah, just we're excited to be here. So.
Okay, and Hayden Harrington's with us also, Momentum Multifamily. Tell us a little about yourself and what you do, Hayden.
Sure. Yeah, excited to be here. So I'm a counterpart to Dustin here at Momentum Multifamily, and we teamed up back in, gosh, we met in 2018, then founded Momentum in 2019. So we've been teamed up for a long time at this point. We've been building our portfolio here in the Houston and now the DFW area. And so we're excited to continue to grow and just offer great investment opportunities. We take a very streamlined approach to all of our deals to ensure that we can operate them as best as possible, and you'll see that kind of throughout this presentation.
Yeah, and we've also Tim Mai, which is one of our partners. He's with Real Estate Mentor and Hero Wealth Fund. He's not here with us tonight, but I partner with him on a big meetup in Houston. He's a very dear friend and a super experienced real estate person. And last and probably least, myself, I'm the founder of Paratus Commercial Group. It's I'm a 20-year plus real estate professional. I got started in transactional real estate, residential, and then I went on to commercial about 3 years ago. I'm here to educate people and help them gain access to private real estate opportunities in the Texas Triangle. And I'm a general partner right now in over 2,000 units in Texas. And I'm really glad to be working with Dustin and Hayden and Tim on this deal. This is the third deal I've worked with Dustin and Hayden on. Okay, so let's talk a little bit about Momentum Multifamily. They've acquired over $350 million in assets since 2014. They've also been operating through a pandemic and a recession. These were tough times, very difficult and challenging times in multifamily, and they've been able to navigate through that. They've owned and operated over 3,000 units here in Texas and Oklahoma, and they have 1,800 units in Houston alone. Okay, it says 886. I think it's maybe a typo when I was correcting this, but it's over 1,800 units right here in Houston. They've gone full cycle on 9 deals, as Dustin mentioned earlier, with an average equity multiple of 2x over an average hold period of 3 years. So doubling money every 3 years, which is a fantastic track record. They focus on Class B and Class A assets, and they're focused on Houston and Dallas both. Hayden lives here in Conroe, Texas, so he's right here in the Houston area, lives just a few miles away from me. And then Dustin's up in Fort Worth, so they have a footprint in both areas, both Houston and DFW, and they're experts on that market. And they're on the properties a lot. So I know Hayden especially puts a lot of miles going to these properties, and he's on site on these, and he can tell you everything about these properties. So it's very much a boots on the ground type of operation. Here's their portfolio looking at right now just in Houston. The one in blue is the property we're going to talk about tonight. And they've got a good footprint all over Houston, a good portfolio. They have scaled in the Houston MSA, and they're experts in that market. So properties that are in the fund, the Henry at Rosenberg, that is going to be in Southwest Houston, Fort Bend County. The Henry at Woodland Hills, which is up on Beltway 8 in the east side, if you know Houston, northeast side. And the Henry at Deerbrook. This is closer to the airport, over by Humble, over by Deerbrook Mall. And we're going to be talking specifically about that property. The fund covers 3 properties. The other ones have been completed as far as the work that we're going to do on those, with refinances, with tax abatements, with things to get those properties where they need to be. And the one we're going to be working on tonight is the Henry at Deerbrook. So there's a picture of the entrance. This is a gorgeous property. I have driven it. I live about 20 miles away from this property, so it's a property I've taken a look at. It's a 2007 construction. It's really good demographics there in the Humble area. There's $150 plus rent opportunity to raise rents. The rents are below market. It's a fantastic location, and it's in a booming market. Humble is a really growing area out in that market, and there's not a lot of development going on out there. So it's a well-developed area. It's old part of Houston, very stable, high incomes, great demographics. This property is a 360 unit property, so it's a large property. Average unit size 1171, so it's a little bit larger than a lot of things in the area. Built in 2007, as I mentioned. Currently 90% occupancy. This is a stabilized property. It's spread out over 11 acres. So this is one of those spread out. It's a little bit quieter. It's not a high density property. In-place rent per square foot is $1.08, and the in-place rent per unit average is $1,270. This has fantastic amenities. They have a great fitness center, obviously a swimming pool, picnic areas, lots of kids to play. There's a lot of families on the property. A Wi-Fi at the pool and clubhouse. There's remote controlled access for security. They do have a business center, Wi-Fi, coffee bar. They have resident functions to build a community instead of just having a place to live. There is garage parking available and covered parking available. And they have storage lockers available for parcel deliveries and things like that. This is a photo of the business area or the lobby in there that they have done in their paint. One thing that Momentum does when they rebrand and they renovate properties is they have a corporate look that goes through all the properties. So there's the same feel. I've been to a lot of their different properties, and you walk in, other than the address, they all look kind of the same on the inside. So it's very important for branding, and they have a real strong brand that they're building. Here's classic units, what they look like. So a lot of the units are older classic units that have not been renovated. This is what a property looks like pre-renovation. So they're nice units. but once they're renovated, it's a huge difference. I'm going to show you some pictures here in just a minute. So this would be an upgraded unit after their team upgrades the property. They do white countertops, granite. They do repaint the cabinets. You've got new handles. You've got different appliances, different colors, and it makes it a much, much, much more modern look to get an updated property, to get a better living environment, more modern, and then obviously to get rent bumps and to collect more rent. Okay. We've got a best-in-class spaces. The average rent in the area is $1,426 at comps, and there's $1,271. So you've got a delta there of about $150 that we can raise rents gradually as people move out. Although the success of this business plan is not just based on raising rents, that's just one part of the equation. So let's talk about rental comps to look at that rent. These are comps that are in the area. The year built is very similar. There's one that's 2023. You can see occupancy in this market, submarket, is really, really good. Average rent per square foot comparable is $1.61. Right now, the Henry at Deerbrook, the rents are $1.47. So there is room to gradually raise rents up in the average. And Momentum does a really good job at doing this because they're really focused on the tenants and providing a great service. So great amenities, quicker repairs. They are super detail oriented and they're trying to give their tenants a great living environment so we can gradually raise rents as people move out. The valuation on this property currently, as far as appraisal, is $76 million. So that has a combined LTV of 69%. That is with the senior debt that they're getting and then the preferred equity that we're adding. For people investing tonight, you're going to be investing in preferred equity, and I'm explaining a little bit about that works in just a moment. So the price per unit is $211 per unit and aligns with many of the sales comps in the submarket there. So the debt financing, the principal balance they're getting on new debt is going to be $50,412. Loan to value of 65%, interest rate of 4.98%. This is going to be a 35-year fixed rate HUD loan that is going to be fixed. And this is going to be something we can pass along to the next owner if they want to assume the loan. So if we have a loan rate of around 5%, the next owner comes in, let's say rates go up, let's say there's inflation, rates are 6 or 7%, and they want to assume the loan, we can pass this along to them. This is very conservative fixed rate financing and a property that's already cash flowing. So it's going to be a very, very good deal as far as instantaneous cash flow, which is what we're looking for. The capital stack, and this is very important to understand when you're investing in preferred equity. And preferred equity is what a lot of family offices, very sophisticated investors take part in. So this is an opportunity to take part of that. The way it works is we have the senior financing. We're going to have the limited partners above that, which is $2 million on this tranche. And then the other partners that are already in the deal and the GPs, they're last people to get paid when we exit on the deal. There's going to be 3 different classes of investment in this. So if you're doing a $50,000 investment, you're going to get a 9%. So it's 0.75% per month rate of return. And then we're going to add an accrual interest of 6% on top of that. So when the property exits, you're going to have a 15% total return. The 6% is paid on the back. If you're going to do a Class B return, which is $150,000 minimum, it's going to be the same thing, but a 10% current return, accrued annual interest of 6% for a 16% return. And then if you want to do a Class A, $250,000, it's going to be 11%, 6, and then a total of 17. The main thing that's interesting about this preferred equity opportunity, on most things that are more like a debt fund, you get 8, 9, 10%, something like that, and there's no upside. So this is going to allow you to get 9, 10, or 11% while you're waiting for the sale of the property. And then on the exit, we're going to add 6% on top of that. The other thing that is going to be very important for people investing in this is that the preferred equity partners get paid first. So If the cash flow is not enough to meet the preferred for the limited partners, preferred equity gets paid first, and then they're just going to have to accrue and they get taken care of on the exit. So you're being placed in a priority place that is basically first in line to get paid. Okay. So the offering on this is a 506C. So it's offered to accredited investors only. If you're not sure about your status, set up a call with me and we'll go over that. But you need to be accredited and you're going to need to provide verification, a CPA letter, a third-party letter, something like that. We do accept cash investments, IRAs, solo 401k, EQRP, or a combination. The minimum investment for this offering is $50,000, and it's on a first-come, first-served basis. So when this last tranche is filled, we'll be closing out the fund and this investment will be completed. So fee disclosures want to go in the fees, and really there aren't any fees. There's no asset management fee on this. There's no acquisition fee. The property's already been acquired, and the asset management fees are already being paid by the other limited partners that are already in this deal. The preferred equity, as we talked about before, 9, 10, or 11%, and then 6% on the back ends for a total of 15, 16, or 17%. There's no refinance fee. So if we go on later and we did a refinance for some reason, rates dropped or whatever, and there's no disposition fee being charged. So when we dispose of the property or sell the property, then the money that we get from that will go directly to the preferred equity partners. Use everybody with those numbers, but we'll go over that in Q&A if we need to. So the steps to invest in this, you need to review the investment, you need to commit. All the paperwork will be in the portal. You're going to have a PPM there, an operating agreement, a questionnaire you'll have to go in and sign, and then you'll fund the investment by wiring in your money. If you're using an IRA, you'll submit paperwork to them and then they'll fund it. And then we'll close the fund out when all the money is raised in the fund. I'm going to show you one more picture slide of some of the property. This is a beautiful property. It's here in Houston. If anyone out there wants to arrange a property tour to make a final decision, I'm sure we could work with Hayden and Dustin to set that up. And I would be happy to meet anyone out there at the property once we've set it up with them and gotten their permission. Let me stop my share here real quick and go back. And then Dustin, Hayden, before we do any Q&A, I want to basically see, I went through this fairly quickly, fairly briskly, and see if you guys have anything to add to what I said or anything before we do Q&A.
Yeah, I guess nothing for me. Well, I've got one or two things, but one thing I guess I would mention is, we started for Fund II, we started paying out in January, and so we've paid, we've hit those numbers, each and every month, and then I'd also just add that as you said, this is Fund II, so we have Fund I that's going. And that's been going since January of 25. And we've hit, all of our expected distributions, each and every month. So for almost 18 months. So anyways, it's been, we invest in it ourselves. We've invested in Fund I and in Fund II. And so I don't know. Yeah, I don't know if there's anything else you have to add, Hayden, but.
Yeah, the only other thing I'll add to is we've actually, so this deal is going into a HUD loan, and this will be our fourth HUD loan. So we've closed the other two deals in the fund, exact same process, basically the same deal. And this will be the third one in the fund, but our fourth HUD loan. And so everything in there is basically in with the same lender. Very similar terms. The business plan, like David stated at the very beginning, our whole strategy in general is very similar. So we're executing the same business plan really across the board. It keeps things really uniform and really nice. And then additionally, we actually already locked our interest rate here at 4.98%. When the 10-year dropped down, we took advantage of that. So we locked that in when we saw that. And that saved us a good bit on our interest rate, probably 25 basis points of interest rate on that. And on a big loan, that makes a big difference. So we're super excited for that, that we were able to time it pretty well. And there's no longer any interest rate risk or anything like that between now and when that deal closes later in this month. So that's another great factor too, is we don't have to worry about the treasuries moving around on us and the effects that that's going to have. And then this is a fixed HUD loan, so it's not a variable rate or anything like that. It's fixed in place, and we're sub 5%, which we're really excited about.
And then I just sorry, David mentioned one more thing. So there's no interest only on this loan. So we're actually paying the loan down each and every month too, which I think is, a neat thing.
Right. And I can like personally attest, I invested in this a little bit earlier. I believe we funded my investment in February or March. I think it was March. And I mean, I'm already getting distributions. So if you're looking for, you're going to fund your investment, and then within 60 days, you're going to start getting good cash flow and good distributions right away. I can personally attest to the fact that that will happen on this deal. You're in a preferred equity situation. You're going to be paid first. The property's already stabilized. So for people looking for cash flow and they want it immediately and they want to start getting their money back right away, this is that type of investment. It's perfect for that. So I'm going to look in Q&A or in the chat. If anyone has any questions, you can go in the Q&A or chat or put those right now. I've got the experts here. Like I said, I've already put $100,000 of my own money in this and already had funded it on the other property. And we're just finishing this deal out to fund this last property that's in here. And if anyone has any questions, please put those in Q&A or in the chat. I'm going to give it a few minutes. And one thing I've really enjoyed working with Dustin Hayden, this is a third deal I've worked on them with. And I invest in every deal with them, and it's just been a great experience all the way around with their team. Promises made, promises kept. Everything has gone smooth. They know how to manage these properties and take over these properties, and it's just been an amazing experience working with them. All right, we must have done really good. I don't see any questions, so I'm assuming everybody's going to invest like right now. That's good, and no questions. Okay, I'm going to give it a couple more seconds, and then if I don't have any questions, we'll wrap it up. And I'll send out a recording to everyone. So if you missed some of this, or if you need a recording, or I'll send this out to everyone. And we'll be sending it also out to all of our Dealmaker Houston live people, our whole group there, once I get it edited up and everything is ready to go. Anything else to add?
Yeah, I've got one other thing to add just to show the kind of history of this property. So we've owned it for, I think, 4 years now. And when we took it over, the NOI at the property was right at $2 million. And we are at 3.8 right now. So we've almost doubled the NOI at the property over 4 years since we've owned it. So that's really good to look at. Even with, pretty challenging times out there over the last few years, we've still been able to drive that NOI significantly, almost 100%. So we're really excited about that. And, that just points to, the property's done well over our ownership, even given the circumstances that are out there and everybody's dealing with right now. And, we're continuing to see incomes continue to rise, and we've got a great team out there too, which makes a huge difference. I mean, our manager there has been with us for just under I think she's just under 4 years. We've got two maintenance guys that have been with us for about 5. We've got our assistant manager's been there with us for 5. So we got a really great team out there. The property's done well and continuing to perform well. So we're excited about getting this refinanced and closed and being able to offer kind of a unique opportunity for investors out there.
And I have another thing to add too. So we've worked with preferred equity from like a family office or kind of a private equity shop. In fact, there's one deal that we did that I guess it's kind of comes to mind that we did in Houston. It's called the Henry at Liberty Hills, and we did preferred equity there And just to give a frame of reference for the returns here versus, it was kind of a different time then. It was kind of, coming out of COVID and a little bit lower rates and all that. But we paid that company a 12% return. It was an 8% current and 4% on that back end. So a total of 12. And we ended up paying them off and all that. But I'm just giving that to show, where rates have kind of gone for preferred equity. And it looks like they're starting to come down now. So anyways, but just want to give that frame of reference.
Yeah. I mean, one thing I love about the way that you have the structure on this is the returns on the immediate cash flow part are very much in line. They're very generous, like you would get in a debt fund. But most people in a debt fund are really limited. It's like, we're going to pay you 9%, maybe 10%. It's 8 to 10% for most people, but there's no upside. So on this, it's a little bit best of both worlds. You have the good cash flow like a debt fund, but then on the back end, there is an adder on top of the 6%. So you get equity like returns on the back end. So, I mean, there's a lot of people right now that have deals. They'd love to have 15, 16, 17% returns on the exit. So this provides you a little bit of both. And since you're in that preferred equity position, you're going to get paid first. So it puts you first in line. So not only are the returns good, the income is really good, the cash flow is great, but it also puts you in a safer position where you're right behind that senior debt. So for people that are a little nervous and like, wow, I want to be in a safer position, it gives you a higher income, some upside, and then also puts you in a safer position. So you're in a lot better position no matter what happens on the property. That's the way I look at it.
And you'd mentioned what our value is versus where our debt is. That's a huge huge span there, and so it's and we're only the total tranche for preferred equity for this asset's only going to probably be around 3 million. So that's anyways relatively in a good spot.
Yeah, I mean, you're below 70%, which, I mean, anything below 70% I consider low to moderate leverage. So it's going to put everybody in a better place. And there's a lot of people out there looking for cash flow right now. And I know a lot of people have been in deals where they haven't cash flowed very good. And this is something that's going to put some immediate cash flow in the bank. And it's really great too for IRAs because you're not worried about the regular income putting it in an IRA. It's going to be, it goes right in the IRA. And you're not worried about the taxes or the type of income or trying to offset or anything like that. So I think it's ideal for IRAs. And that's the way we did it, was inside of an IRA. All right. Anything to say, guys, before we go? All right. I'm going to leave it at there then. Okay. So thank you, Dustin, Hayden, for being here tonight. I will send out a recording to everyone. Appreciate everyone being on the call. And everyone that signed up tonight, I will send a recording out and I'll follow up with everyone and get on this deal before it is too late, because it will be going away probably in a few weeks.
Yep.
We'll get it finished up.
Awesome.
Thanks, everyone. Have a good night. God bless all of you.
Thank you.
Thanks, guys.
See ya. Take care. Bye.